It's Monday, the 16th of December, and welcome to another edition of Monday Market Picks. My name is Tilan Vikramasinghe. I'm the head of research for Maybank Securities here in Singapore. Now, the stocks in Asia are heading back into the red on weaker than expected sales data in China. As well as markets expecting quite a few central banks to make announcements this week. We've got the Fed, Bank of Japan, Bank of England, all coming out and due to meet this week. So there's a lot of uncertainty and volatility in the market. Now, one thing, though, is for sure, Singapore is up 18% year to date, making it one of the best performing markets in Asia. We reflect back on what some of those key drivers were and how they will impact next year. We also have Brian, our Singapore economist, joining us to give his views on GDP, inflation, and potential for an election budget next year, sorry. And then we also have two trading buys from our chart guy as well. But before I go into that, just want to highlight our brand new Singapore trading app that we have launched. A lot more interactive, a lot more charts, a lot more news in this app. So do make it a point to download this app if you haven't done so already. Now, let's start with Singapore first. Now, I asked all our analysts to think back through 2024 and identify what were the key drivers that moved their sectors this year. Broadly, they came up with three overall themes. First, we are starting to see AI applications delivering more use cases. We'll put the top picks up a bit later on. We don't need that right now. And the first such sort of instance where we are starting to see AI applications coming through is actually in banks and healthcare. Second, we saw laggards from 2023 actually coming back with some structural support, and especially sectors like offshore and marine, as well as internet. The third is we saw the restructuring theme continue to keep pace, especially this was true for the S-REITs as well as for industrials as well. So I have Krishna, Hussaini, as well as Jarek joining me to give some overviews on their different sectors. But let me start off with the banks first. We think they actually managed to monetize Singapore's safe haven status very well this year amidst all the global uncertainty. We had global conflicts, political uncertainty, as well as slower than expected growth coming from China as well. Singapore very clearly established itself as the regional financial center, moving away a little bit from Hong Kong. Now, one of the biggest drivers we saw was their private banking asset under management. That actually increased between 10 to 24% just in the first half. And that's the latest information we have. We expect a similar sort of percentage increase in the second half as well. Now, the banks are sitting on a lot of dry powder. Most of that is actually sitting as fixed deposits. And now, as we go into 2025, you expect a lot of these private banking RMs that these banks hired will be trying to convince clients to convert some of these FDs into more fee-generating products. And we are seeing that already happening for most of the last 3 quarters. We think that pace can actually pick up a lot more as we go into 2025. At the same time, interest rates have actually been higher for longer amidst Trump administration's potential inflationary policies. So I think the central bank, the Fed, might be a little bit more reluctant to cut going into next year. Now, that will be supportive of net interest income as well. Second, we saw a lot more hyper-personalized service offerings from the banks, mostly as they are deploying more and more AI applications on the front end, but also on their back end as well. Now, if you look at Singapore banks, they are spending about 4 times more than the Malaysian banks and 5 times more than the Indonesian banks as a percentage of assets on their tech infrastructure. So we think on a regional basis, the Singapore banks will probably be the most geared towards this AI revolution and in terms of AI applications as well. So this will help them keep their costs low as well as their revenues growing over the near term. And I think the two banks that will benefit the most will be DBS and UOB. They have both very high fee income bases, which can grow, particularly with all the AUM they have been receiving. And they've also been investing a lot in their tech platform, so they will be able to monetize that a lot faster as well. So that's something to watch out for as we go into 2024 for these banks. Now, at this point, let me pause on the banks and bring Krishna on the line. Krishna, you've got two sectors that you reflected back on for our reflection piece, which is real estate as well as industrials. So let's start with real estate. What are your key sort of themes when you reflect back for 2024?
Thank you, Thilan, and good afternoon, everyone. So yes, I think the real estate sector and the REITs, they continue to restructure their portfolio, and they took advantage of the fluctuations in the yield curve to refinance their hedges as well as the liabilities. Overall, as you can expect, I think the performance was closely tied to the movement of the yield curve and the expectation of where the Fed funds rate trajectory is going. So year to date, we are seeing the sector down about 10%, and we have seen the 10-year yields going up by about 20 to 25 basis points. So it's sort of along the expectation, and then the refinancing of the debt weighed on the bottom line. So in line with the REIT manager's earlier guidance, they are using this this kind of a macro environment to divest their low-yielding assets and either de-gearing or investing in assets where they think the future opportunities could lie. Overall, we have seen the central bank to be very supportive. They have simplified and eased the leverage norms. And within the developer space, they have been exploring and talking up the asset-light strategies and guiding towards a better capital allocation and a focus on profitability.
Got it. And what would you think are the key sort of stocks that you would be looking out for next year?
So within the stocks, we have on the commercial side, we will go for the CICT, and then within the high yield sort of space, Lend-Lease REIT and OUE REIT, again with very Singapore-focused assets. Within industrial space, we are going a bit more on the logistics with the supply chain theme of China Plus One, and then capital and ascenders, which is a lot more diversified. And then within the hospitality side of things, we'll go with CDL Hospitality Trust, Far East, and Class. Again, with hospitality, the tourist arrivals picking up, albeit slowly. All the three names will benefit. So those will be the picks within the sector space.
Got it. And then just moving on to industrials, what are your reflections on that sector?
Yeah, I think that sector is probably a lot more kind of doing the medium-term restructuring, and they are continuing with the strategic plans. So Sembcorp Industries, it secured the gas supply. It signed long-term power purchase agreements with the MNCs out here, and they are also pursuing their renewable strategy, and they have won some chunky renewable orders in India. It is also piloting the first power import from Malaysia, which is in line with the Singapore's policy of using regional power grids as one of the way to secure energy supply. For ST Engineering, they are further expanding its international defense business, which is one of the pillars to internationalize their overall portfolio. They have secured orders in Europe. The aerospace business, which has gone through some turbulent times during the COVID, they are focusing on more on the maintenance, repair, and overhaul because the airlines are using now a lot more of the older planes. So the passenger to freighter business that is a bit more subdued. For the satellite communication business, that is a bit slow. The sector is undergoing structural changes. So both these names are sort of realigning with their, the midterm goals that they have laid out. And we expect these themes to continue in the medium term. Obviously, near term, we will be watching for any policy changes towards renewable energy. And then the growth shocks can also create some demand supply imbalance, leading to the lower capacity utilization. So that we will watch out for Semcop and for ST Engineering. We expect these defense orders to start boosting its order book, which we look forward to in their further disclosures during the March Investor Day that they will be hosting next year. So topic, I think, will be Semcop Industries for now as we wait and watch on ST Engineering as how their order book evolves.
Got it. Thanks, Krishna. Now let's bring Hussaini here. And Hussaini, I want to talk about the telcos first. So what are your reflections on telcos for 2024?
Sure. Thanks, Tilan, and good afternoon, everyone. So obviously, telcos did better, especially Singtel in 2024, and it was helped by some restructuring and mostly its higher dividends, not just in 2024, but the guidance till 2028. Now, one of the key theme we picked up in 2024 is the emergence of Simba, which is the number four mobile operator in Singapore. I call it Simba is ready to join the pride. So Simba posted a 117% year-on-year revenue growth in FY24 and 50% EBITDA growth, 50. Uh, Admittedly, Simba is still subscale at just 5% revenue market share. But why we think it can weigh on competition is due to its pricing, which is still 40 to 50% below that of larger peers. Moreover, even at such a subscale market share, Simba's EBITDA margins are at a healthy 42% and it is FCF positive, which means it can continue to sustain its operations. Additionally, it has a strong balance sheet as well. Now, where it creates a problem going forward over the medium term is that Singapore is up for consolidation, mobile consolidation, and common wisdom suggests that competition should sustain or should subside. Sorry, should subside with consolidation. However, we are of the view that the subscale Simba may remain aggressive even if industry consolidate and may continue to dwell on market share gains to grow. This would make consolidation relatively ineffective to bring competition down.
Got it. And then your top picks that you think will benefit the most from this?
Means it does create some headwinds for the sector. So our topic is Singtel. Now, Singtel, in our view, is relatively insulated from Simba's aggression, is because Singtel is a wider group, and the Singapore consumer side, which is mobile and fixed broadband, is less than 10% of its SOTP. For Singtel, there are other tailwinds, growth tailwinds like data center, Optus turnaround, and more importantly, Singtel is undergoing all this capital restructuring where they are looking to raise another $6 billion on top of $2 billion which they have already raised, and that in turn translates to higher yields going forward and potential for share buybacks. In our view, startup is relatively vulnerable because 41% of its revenues comes from Singapore mobile and fixed broadband.
Got it. And then just shifting focus to the internet sector, Hussaini, what are your key reflections there?
Yeah, sure. So ASEAN internet companies did made a strong comeback in 2024 with the sector up almost 100% year to date. Now it was a across the board turnaround for the internet sector. But if I have to pick up one key theme, I would say that the strong fintech momentum uh, was the key standing point in FY24, and in our view, it had been relatively overlooked given its smaller contribution to the overall SOTP. So in number terms, in 9 months of 24, fintech revenues were up 90% year on year. Now, over the medium term, we expect fintech could effectively evolve into a larger force. ASEAN's high underbanked or unbanked population creates a significant untapped opportunity, and we are of the view that the pieces are finally in place, which in turn could pave for fintech to emerge as a prominent force ahead.
Got it. And then within that space, your preferred picks going into next year is CE and Grab. Would that be the order?
Yes, we are buy on both the names, C and Grab. Preferred pick is C Limited. We see multiple tailwinds at play. This include under penetration of e-commerce and potential for tech rate increases. ASEAN tech rates are at the lower end of global peers, so there is a long runway for them to increase the tech rates. We also see competitive mode for C Limited, particularly in their logistics business. They have their own logistics infrastructure, and they have also built live streaming capabilities. And last but not the least, they are growing fintech presence as well.
Perfect. Thanks, Hussaini, on that. And let's bring Jarek here. Jarek, welcome to the show. Can you give us your reflections? Maybe let's start with the offshore and marine sector, and then we look at tech manufacturing.
Sure. Hi, Dylan. Okay, so for offshore and marine, right, basically we do remain bullish on the sector. Firstly, we think that charter rates, which has done well in the last 2 or 3 years, will continue to rise gradually for next year. And as utilization rates across the fleet of most players remains high, above 80 to 90%. So we do think that, these charter rates will continue to hold and rise, because if you look at the supply and demand imbalance, it is still there. The new supply upcoming, it's still quite slow. I think you will see new builds coming up in the next 2 or 3 years. But in the next year or so, new builds will still not be quite prevalent because of the building time. And also, if you look at demand from both oil and gas side, as well as the renewable energy side, offshore wind farm, offshore solar, remains to still be strong. So as a result, we do expect this charter rates and utilization to remain high in the next 1 year or so, at least for next year. Going forward, we also think that the FPSO new build pipeline remains to be strong as well, with a lot of more new builds coming up. There's about 66 FPSO projects planned between 2023 to 2027, and this number is set to increase as more investments are being placed into assess new reserve in the deep water segment. As a result, we do think that, going forward for any FPSO related players, they should continue to still do well in the next few years as well. The only caveat we have is on Trump, upcoming Trump, because he wants to increase oil production in the US, and with that, it may sort of tip the imbalance, the scale between for oil demand and oil price. So oil price may suffer as a result if Trump relaxes the rule to actually produce more oil in the US. And it also depends on how the Middle East reacts to that. So oil price may be the one of the main factors that may impact the supply and demand for charters and everything, FPSOs going forward. So that could be the only caveat that we have that will hurt oil prices. Our topic, so basically, that's in general the overview for the oil and gas sector.
Got it. And the topic for this sector is?
Our topic is actually Marco Polo Marine. We believe that, offshore wind farm projects, there's a lot slated to come out in the next 2 to 5 years across Southeast Asia and Asia, Japan, Vietnam, Korea. And we think that, Marco Polo, which is pivoting towards for growth in offshore wind farm, will be one of the key beneficiaries of this growth. Of now, more than about half of their vessels are already chartered to offshore wind farms, and going forward, most of their growth will be focused on the offshore wind farms in Korea, Taiwan, Vietnam, as well as Japan. And we do think that they will likely benefit from rising rates as well. Their new CTV is also upcoming, their new CTVs are also upcoming, and also their CSOV, which is also slated to be completed by January, should also be commencing operations from March to April onwards next year. So revenues will kick in from then. As a result, we do think that likely FY25 will be a good year for Marco Polo. And next, we are also quite bullish on Citroen, but it's a non-rated for now. We think that they will continue to benefit from the FPSO strong pipeline, and their margins will likely also recover as the old orders deplete with lower margins. Yeah. So that's all for the offshore sector.
Got it. And then very quickly, Jarek, maybe in 10 seconds, just tech manufacturing. What's your very quick take?
Sure. Okay, so I think that in 2024, the boom has been the recovery has not been strong as expected. But we do think that going forward, those 2025 remains quite challenging for now. A lot depends on whether Trump what will Trump do to China as well as the rest of Southeast Asia. Will there be more tariffs, or will he inflict quite a bigger tariffs on China? Currently it's about another 10%, but we don't know if things will change. For now, we still think that Franken is our preferred topic for now, as we do see quite uncertainty over the tech sector in the next 3 to 6 months, and we only have more clarity after Trump's come on board. So I think that our topic remains Franken, but overall, we are still quite sort of neutral to negative on the tech sector. It's still quite uncertain for now. Have to wait for Trump to come on board first.
Okay, so we wait for Trump for tech manufacturing. Thanks, Jarek.
Yep, welcome.
Let me bring Brian here. Brian, you just published a piece on Singapore's macro outlook, and you're expecting very resilient growth for 2025. But maybe very quickly tell us, before we talk about outlook, how do you think Singapore fared in 2024, and where do you think growth will land?
Yeah, thanks, Dylan. Yeah, it's a mix of drivers. So our services sector has been very strong, I think, throughout so far throughout in 2024, maintaining growth at about 4% for the first 3 quarters. So we had a mix of drivers here. Of course, the trade-related sectors like wholesale trade, transport and storage, they're benefiting from increased port activity and also the recovery in global trade. Of course, our accommodation, tourism-related sectors will also gaining from a resurgence in tourist arrivals. I think particularly those China tourists. And of course, our modern services sector, we had Infocom benefiting from sustained enterprise demand for digital solutions, and finance benefiting from Singapore's rising role as a wealth management hub, as well as increased trading activity in 2024. Our manufacturing sector, I think it strengthened to a big degree, especially in the third quarter. We had growth of 11% year on year in the third quarter. And I think that's because the basically electronics recovery globally is broadening beyond just advanced node AI chips. I think there's broadening use of AI applications. Yeah, so we are looking at growth this year, overall GDP growth this year at a quite standout 3.6%. Yeah.
Got it. And then how are you thinking about 2025? What's going to drive Singapore in 2025? And where do you think, what are your forecasts for growth?
Yeah, so we're forecasting GDP growth to remain resilient at 2.6%. And I think that's quite close or even higher than Singapore's past few years of trend GDP growth rate. So what are the drivers? I think a few factors: easing monetary conditions first, second, a generous election budget, and third, construction of major projects in the pipeline, which will altogether help to cushion the uncertainty and shock from Trump's trade policies and tariffs and all that. I think if I were to break down the drivers, first, trade, even though in the second half the outlook is clouded by Trump's tariff, but I think in the first half, front loading of orders before new US tariffs are effective may actually boost manufacturing and exports, given all the diversion of flows as well as manufacturing activity. On easing monetary conditions, we are expecting MAS to ease monetary policy in January, and that's as inflation returns to pre-pandemic norms. Interest rates have already been sliding. If you look at the benchmark SORA interest rate, it's already eased to 3.2% at end November from 3.8% in 1 year ago. We're expecting the rates to ease further, given that the Fed is still projected to make calibrated rate cuts of 75 basis points in 2025. And of course, general elections are due no later than November 2025. And we have one budget 2025, scheduled for February, which will be the last of this term of government. So we're expecting the budget to be quite generous. I think we are expecting social transfers to help address cost of living concerns. And these cover areas such as housing, food, healthcare, utilities. We're also expecting some goodies for the firms, such as corporate tax rebates, given higher than expected revenue collection and need to remain competitive to investments. And I think the third key driver in 2025 is that the construction sector has a major pipeline of mega infrastructure projects from T5 to the ongoing Tuas Megaport, and also expansion of our integrated resorts, MBS and RWS. At the same time, the government is also ramping up the construction of built-to-order flats, and private home sales have recently been picking up, so that could actually support more new launches in 2025. So yeah, I think with the construction sector, I think construction could be one of the major drivers of growth.
Got it. Thank you, Brian, for that. So a lot of resilient growth, multiple drivers going into 2025. With that, I just want to quickly highlight, we've got two trading ideas from our chart guy, LEONG Asia, as well as JAPFA, both of them on trading buys. So do have a look at that. And then we just have a quick look at upcoming events. One of the biggest events we are having is on the 18th of January. We got our market outlook as well as our feng shui event. This is a very popular event. This time it's at the Singapore Center. So do sign up and join us for that. With that, we are out of time. I just want to say thank you very much for your support this year. We'll be taking a short break from today till the 6th of Jan. So our market daily, this show, as well as our Monday, as well as our daily newsletters will be off the air till then. So do come back and join us on the 6th of Jan. I want to wish you a very happy holiday season and a very profitable 2025, and see you next year.